Ever really, stop and think about what makes a specific company truly tick? Not just the logo, but digging way deeper.
Yeah, beyond the surface stuff.
Exactly. Today, we're doing just that. We're focusing in on one name, American Express. We're going to try and peel back the layers, see what makes them stand out.
And we've got some serious material to work with. We've based this on a really detailed AXP Deep Research Analysis report, and it's fresh data up to April 24th, 2025. Think of this as your shortcut to getting up to speed on Amex.
Right. The mission here is to pull out the absolute must-know insights. We're talking business model, management, financials, market buzz, the works.
And we're looking at it through a specific lens, sort of like value investing principles. Think Warren Buffett style, looking for quality, looking long-term.
This deep dive comes from that research report, and it uses a share price from April 23rd, 2025, $260.14. For context, it's packed with info, and we're here to, guide you through it.
Yep. So the plan is, first half, we'll hit the fundamentals, the business itself, the leadership, the financial health. Then second half, we switch gears a bit, look at market sentiment, who owns the stock, the risks involved, and then, wrap it all up with a conclusion, covering all the key chapters from the analysis.
All right, sounds like a plan. Let's jump right in. The business itself, what's the core of Amex?
Well, the really key thing about American Express is its closed-loop payment network. It's quite different from what you see with Visa or MasterCard, which are called open-loop.
Closed loop versus open loop, what's the practical difference there?
So in many cases, Amex is the one issuing the card or running the network that processes the payment. And sometimes they're even the merchant acquirer, the one handling the relationship with the store.
So they control more pieces of the puzzle compared to Visa or MasterCard, who mainly connect different banks.
Exactly. They're involved pretty much end-to-end in a lot of transactions. And that structure directly impacts how they make money.
Okay, so let's talk revenue. How does Amex generate its income?
There are three main streams. The biggest one is called discount revenue. This is basically the fee merchants pay Amex every time someone uses an Amex card.
A swipe fee, essentially.
Precisely. And it's substantial. In the first quarter of 2025, that was $8.74 billion. So more spending on Amex cards means more discount revenue.
Makes sense. What's number two?
Second is net card fees. And this one's been growing really fast. It brought in $2.33 billion in Q1 2025.
Oh.
Yeah, and that was up 20% year over year if you adjust for currency changes.
Yeah.
This is the money people pay annually for holding the cards. Think the platinum, the gold fees.
Right. So that big growth shows their premium strategy is working. People are willing to pay those fees.
It definitely looks that way. It points to that premium sort of subscription-like model really taking hold. And it makes their revenue a bit more predictable, which investors tend to like.
Okay, predictable income, premium focus, got it. And the third mainstream.
That's net interest income. This came in at $4.17 billion in Q1 25, up 11% year over year, FX adjusted. This is the interest they earn when cardholders carry a balance on their credit cards, plus interest from other lending.
So because they issue the cards directly, they take on the credit risk, but they also get the reward if people revolve a balance.
Correct. They also have a smaller category, service fees and other revenue, about $1.72 billion in Q1, which includes things like commissions from travel bookings.
So they earn when you swipe, when you pay the annual fee, and when you borrow. Pretty diversified within payments.
It is. And they structure the business around three main segments. The biggest is consumer and international card services. That's expected to be maybe 64% of revenue in fiscal 25. Covers consumer cards, international business.
Okay.
Then you've got global commercial services focusing on businesses, and global merchant and network services, which handles the merchant relationships and the network itself.
And it's not just about the cards anymore, is it? They offer a lot more.
Oh, absolutely. The cards are central, of course. Charge cards, credit cards for consumers, small businesses, big corporations, co-brands like Delta, Hilton. But yeah, it's much broader.
Like what?
Well, their merchant services now include things like data analytics. They have travel and lifestyle perks, airport lounges, booking platforms, even dining through Resi and Tech Talk, which they acquired.
Right, Resi and Talk.
And for businesses, there's expense management tools, B2B payment solutions, this thing called Business Blueprint for cash flow management, SME lending, partly through buying Cabbage. Oh, and they offer deposit accounts too. They're a bank.
It's a whole ecosystem they've built. So where do they stand in the big picture? Market share, scale.
They're the fourth largest network by the amount spent on their cards globally. But remember, their game is premium. In the U.S. in 2024, they had about 11.1% of purchase volume. Visa was huge at 61.1%, MasterCard 25.8%.
So much smaller volume share than the big two.
Yes. But interestingly, in the U.S., where merchants accept Visa and MasterCard, 99% now also accept Amex. So acceptance isn't the hurdle that maybe once was domestically.
Okay.
Globally, they had over 140 million cards out there at the end of 2023, accepted at around 108 million places in 2024. And the key thing is, because they focus on higher spenders, the average amount per transaction is typically quite a bit higher than competitors.
Fewer swipes, but bigger amounts each time, which ties into their famous slogan, membership has its privileges. What really backs that up?
It's a few things. Definitely the premium rewards, membership rewards, points, travel benefits. Also, their reputation for superior customer service is a big one. Then there's the brand prestige, the sort of status symbol aspect. Their appeal is targeted at affluent folks, SMEs who value those perks. And finally, the access and insights they provide through their network.
Okay, let's quickly recap Chapter 1. Amex.closed loop network makes money from merchant fees, discount revenue, card fees, and interest. Big focus on premium customers and building an ecosystem around them. Not the biggest by volume, but strong in the high-value segment. Membership does seem to have its privileges.
That sums it up well.
All right, let's move on to the people running this show. Chapter 2. Management evaluation. Who's in charge?
The CEO is Stephen Squeri. He took over in February 2018, but he's a long-timer at Amex, been there since 1985.
Wow. So he knows the company inside out. What's his track record like as CEO?
Pretty strong overall. He successfully steered the company after they lost the big Costco partnership, which was a major blow. He's really driven that focus on premiumization, push tech investments, and the results speak for themselves. Fiscal 2024 saw record revenue, over $66 billion, and net income, over $10 billion. He's also overseen some key acquisitions like TikTok, Room, Cabbage Center.
You mentioned the Costco loss. That must have been a huge challenge. How did management handle that crisis?
It really was. Their response was basically to double down on their core strategy. They significantly ramped up investment in marketing and rewards to really strengthen the value proposition for their direct cardholders and attract new premium customers.
So instead of panicking, they invested more.
Exactly. And the fact they recovered and grew beyond that shows, I think, management's adaptability. They also navigated the pandemic pretty well, adjusting benefits and keeping credit quality strong. Now, the current challenge is the talk about potential U.S. tariffs in 2025, but management has publicly reaffirmed their guidance for the year.
Seems confident. How are they on communication? Do they keep shareholders in the loop?
They seem quite transparent. You get regular, detailed earnings releases, investor calls, presentations. All the SEC filings are there on the investor relations site. They also provide FX-adjusted numbers, which helps clarify underlying performance.
What's FX adjusted?
Just means they show the growth rates taking out the impact of changing currency exchange rates so you can see how the actual business operations are doing. They also address shareholder proposals in their proxy statements pretty directly.
Okay. What about the ethical side? Reputation? Any red flags?
Generally, the Amex brand reputation is strong, built on trust, service. They did face an antitrust lawsuit in the past, which is not uncommon for major financial players. More recently, there have been some shareholder proposals looking at things like executive pay. Specifically, they mentioned removing DEI-linked incentives and advertising policies. They also file things like an ear notice, which is standard compliance for international operations. Nothing that jumps out as a major scandal recently.
So bringing it together, management capability, honesty, shareholder focus, how do they score?
Capability seems high. They've handled crises, executed strategy, delivered results. Honesty looks good too, based on their detailed reporting and addressing concerns. Shareholder orientation, generally strong. Look at the capital returns, big buybacks, rising dividends.
But I sense a but.
Well, the one thing that gives pause is the recent insider selling. The CEO alone sold over $65 million worth of stock in the 6 months before this analysis. During that same time, there was only one insider purchase by a new director.
65 million, that's a lot.
It is. Now, insiders sell for many reasons, diversification, taxes, etc. But the sheer volume of selling compared to buying, it's something investors might want to weigh when thinking about management's alignment, even if the company's public statements are optimistic. Also, executive compensation has faced some scrutiny, though they say those DEI metrics are gone now.
Definitely a point to note on the insider sales. Okay, let's talk about where they put their money. Capital allocation, where the investment's going.
A lot goes back into the core business. enhancing value propositions, better rewards, perks, expanding merchant coverage. Marketing is big, though it was flat year over year in Q1 25 after some big increases previously. Technology, digital platforms, data analytics like that business blueprint for SMEs, and of course, talent.
And acquisitions, you mentioned a few.
Yeah, their M&A seems focused on strategic, bolt-on deals, talk and room for dining, cabbage for small business lending tech, center for expense management, things that enhance their existing ecosystem. They also sold off their certified fraud business in 2024. Doesn't look like they're hunting for massive company-changing mergers right now.
What about returning cash to shareholders? Buybacks.
Oh yeah, share buybacks are a huge part of their capital return story, often bigger than the dividends. They authorized buying back up to 120 million shares in 2023. In fiscal 24, they returned $7.9 billion total through buybacks and dividends.
And buybacks help boost earnings per share, right? By reducing the share count.
Correct. Fewer shares outstanding means the total profit is divided among fewer shares, potentially lifting the EPS number.
And the dividend itself, you mentioned it's growing.
Very much so. Long, consistent payment history. And the recent growth has been really strong. 15% bump in 2023, almost 17% in early 2024, and another 17% increase announced for Q1 2025, taking it to $1.82 per share quarterly.
Wow, that's impressive growth.
It is. That's at least 4 straight years of big increases. The 5-year and 10-year average growth rates are solid too, around 10–12%. The current yield is about 1.3%, and crucially, the payout ratio is super low, like 20% of earnings.
Meaning they only pay out about a fifth of their profits as dividend.
Exactly. That signals the dividend is very safe and leaves tons of room for reinvestment in the business and future dividend hikes.
Very healthy. Now, a key metric, return on invested capital, ROIC. How well are they using their capital to generate profit? This can be tricky for financials.
It can be calculated differently, yeah. But one source, Finbox, put their trailing ROIC around 11.8% as of March 2025. The 5-year average was closer to 9.6%. Historically, way back before 2014, they actually had ROIC above 20%.
So it's lower now than it used to be.
It seems peak profitability might have moderated. It dipped really low in 2020, like 4.2%, but recovered to this 10–11% range. The important thing, though, is that most sources agree their ROIC is generally above their cost of capital, their WACC.
Meaning they're creating value with their investments.
Right. Even if it's not back at those 20% plus peaks, they're still generating returns above their cost of funding those investments. Maybe the competitive landscape or business mix has changed, affecting those peak returns.
Okay, so summing up capital allocation. They invest strategically in the business, make disciplined small acquisitions, return a lot of cash via buybacks and a strongly growing dividend, and generate solid, value-creating returns on capital.
That seems like a fair assessment.
Excellent. Now let's pivot to the numbers. Chapter 3, Financial Health. Let's run through some key metrics as of April 2025. Market cap.
Around $182 billion, give or take, market fluctuations.
PE ratio. How's the valuation looking based on earnings?
The trailing PE was around 18–19. That's a little higher than its 10-year median, which is closer to 17, and the historical average around 17.7. The forward PE, looking at estimates, is a bit lower, maybe 16.4 to 17.4.
Okay, slightly above average historically, but maybe normalizing based on forecasts. What about revenue growth?
Pretty strong recently. Trailing 12 months ending March 25, revenue is up about 8.5%. Looking annually, fiscal 24 was up over 10%, FY23 over 21%,
Yeah.
FY22 over 27%. Though those last two were big recovery years post-pandemic.
Right, got to factor that in.
The 5-year average growth is maybe 8.7% to 9.7%. Q1 25 specifically was up 7% reported, 8% FX adjusted, just slightly missed analyst expectations, but they reaffirmed their full-year guidance of 8–10% growth.
And profitability, margins holding up.
Yeah, margins is pretty healthy. Gross margin around 64%, fairly stable. Operating margin in the 17–20% range, also stable. Net margin, that recovered nicely after 2020, now in the mid-teens, maybe 13.5% to 16.6%. Q1 was 16.3%.
Still strong, but maybe a little off the absolute peak from 2021.
Slightly, yeah. Could be higher rewards costs, competition, things like that causing a bit of compression. Still very profitable, though. FY24 net income was over $10 billion.
What about debt? How leveraged are they?
Their debt-to-equity ratio is around 1.6 to 1.7. That's actually a big improvement from before 2019 when it was over 2.5. So they've deleveraged significantly.
That's positive. Free cash flow. You mentioned it's volatile for financials.
It really is. Annual numbers jump around a lot. $12 billion in 24, $17 billion in 23, $19 billion in 22. Q1 25 cash flow from operations was $4.76 billion. The trailing FCF yield was maybe 6.5%.
So hard to read too much into one period.
Exactly. The trend matters more.
Yeah.
And the fact they consistently return billions of buybacks and dividends suggests they generate enough cash over the long haul.
Okay. Last metric here, price to book. How does the market value compare to their accounting book value?
It's quite high, around 5.6 to 5.9 times book value. That's way higher than peers like Capital One or Discover.
Why so much higher?
It likely reflects Amex's higher profitability, especially its return on equity, which is very strong, around 33, 34%. The market's willing to pay a premium for that level of return.
Got it. So quick financial health check. Profitable $10 net income, strong margins and ROE, balance sheet improved with less debt, lots of cash, 52 billion up plus in Q1, healthy capital ratios, CET1 10.7%, stable funding with lots of deposits, 70%. Seems solid.
Agreed. Now let's look at stability. Earnings consistency.
Generally consistent over 5-10 years. But yeah, there were dips, 2017, definitely 2020 with COVID. But the recovery post-2020 was strong. Record EPS in FY24 up 25%, and Q1 25 EPS up 9%. And that growing fee revenue helps add predictability.
Dividend stability and growth.
Highly stable, paid consistently for over a decade, no cuts. And as we said, recent growth is impressive, double-digit hikes the last few years. Plus, that low payout ratio, around 20%, supports future stability and growth. Very safe-looking dividend.
Debt management.
Looks prudent. They've actively lowered the debt-equity ratio, shifted funding more towards stable deposits. They have diverse funding options. Seems well managed.
Working capital. You said traditional metrics aren't as relevant.
Yeah, but related factors look okay. Loan growth is solid, and importantly, credit quality remains strong. The net write-off rate was stable at 2.1% in Q1, even with loan growth, which is a good sign.
So, wrapping up financial stability. Earnings have some volatility tied to the economy, sure, but the core business is profitable and fee income is growing. And definitely no signs of excessive debt. Leverage is down, funding is stable, capital is good.
Right. So overall, a financially healthy and stable picture, but with the usual caveats about economic sensitivity. Okay, that closes out the first half, business, management, financials.
Now, let's shift focus outwards. Chapter 4, market sentiment. How's the market feeling about Amex right now, around April 2025?
It's a bit of a mixed bag, honestly. Coming into late April, the stock had actually lagged the S&P 500 year to date. A lot of that seemed tied to those worries about potential U.S. tariffs and the general economic outlook.
Maybe the recent earnings help?
Probably. They reported Q1 earnings mid-April, beat expectations on EPS, and importantly, they reaffirmed their full-year guidance despite those tariff concerns. That likely calmed some nerves. Plus, you always have the Berkshire Hathaway factor. Their huge stake gives a lot of investors confidence.
What are the analysts saying? Price targets, recommendations?
The average target price for the next year is somewhere between $290 and $310, compared to the $260 price in our analysis. That suggests some moderate upside. But there's a really wide range of opinions. Some analysts are down at $230, others way up at $380. Big difference.
Yeah, quite a spread. As for recommendations, it leans towards buy or hold. Roughly 43% say buy, about 50% say hold, and maybe 7-12% say sell. One firm, Redburn Atlantic, did upgrade them to neutral recently.
Okay, so generally positive but cautious maybe. What other news besides earnings might be affecting sentiment?
Well, just before earnings, they announced they were acquiring Center, that expense management company. That probably helps the story around their business services. And back in March, they announced that big 17% dividend hike we talked about, payable in May. Dividend increases are almost always viewed positively. They also added Michael Angelakis to their board in March.
Okay, so mixed sentiment, but some positive news flow recently. Let's move to Chapter 5, ownership. Who actually owned AXP stock?
It's heavily owned by institutions. The giant in the room is Berkshire Hathaway, holding around 21.6%. They've been a massive long-term holder.
Nearly 22%. Wow. Who else is big?
You've got the usual large asset managers. Vanguard has about 6.5%, BlackRock around 6.3%, State Street near 4.3%.
Yeah.
Then JP Morgan and Wellington Management each have a bit over 2%.
So the big institutions dominate. What about insiders? Management?
Insider ownership is actually quite low as a percentage. CEO Squeri holds something like 0.03%. But as we discussed earlier, the transactions are notable, specifically the selling.
Right, the $65 million plus sales by the CEO. versus just one purchase.
Exactly. 28 sales versus one purchase in the 6 months prior. The only buyer was that new director, Angelakis.
So very concentrated ownership with Berkshire and the top institutions holding over 40%. Any implications there?
Well, having stable long-term holders like Berkshire is generally seen as a positive. It can reduce volatility. But the flip side is if one of those huge holders did decide to sell a large chunk, it could definitely move the stock price significantly. They have a lot of influence.
Makes sense. Okay, we understand the business, management, financials, sentiment, ownership. Now for the potential bumps in the road. Chapter 6, Risk Assessment using a SWOT analysis framework. Let's start with the good stuff. Strengths.
Key strengths are definitely the powerful brand, that loyal, high-spending customer base, the closed-loop advantage we talked about, their integrated models, strong financials, and that effective capital return program. Those are big positives.
Agreed. What about the weaknesses?
On the downside, their merchant fees are typically higher than Visa MasterCard, which can still be a friction point, especially internationally. The business is definitely sensitive to the economy, particularly high-end spending. There's always a risk concentration with big co-brand partners, remember Costco, and their overall volume share is just lower than the big networks.
Okay. Opportunities. Where can they grow?
Lots of potential. Continuing to capture millennials and Gen Z, expanding that SME ecosystem, more services, tools for businesses. International growth is still a big runway, constantly enhancing digital offerings. And the ongoing travel recovery is a clear tailwind for them.
All right, now the big one, threats. What keeps management up at night?
Top of the list has to be an economic slowdown or recession. Closely related and very specific right now are those potential 2025 U.S. tariffs. The worry is they could curb spending, fuel inflation, hurt GDP, all bad for Amex.
That seems like the major near-term cloud.
It does. Beyond that, you have intensifying competition from other card networks, banks, fintechs, buy now, pay later. Adverse regulations are always a risk in financial services, shifting consumer tastes. Cybersecurity is a huge, constant threat. And again, the risk of losing a major co-brand partner.
That's a comprehensive list of risks. Okay, Chapter 7, Conclusion. Let's try to synthesize all of this. What's the bottom line on American Express as of April 2025?
I think the analysis points to a really high-quality company. It's got clear competitive advantages, that brand, the closed loop. It's proven resilient, but it's definitely facing external headwinds, especially those potential 2025 tariffs. It's not risk-free.
And if we think back to those Buffett-like principles we mentioned at the start, does Amex fit?
Mostly, yeah. The business is pretty understandable at its core. The long-term prospects look favorable, but with that tariff caveat, management seems able and trustworthy, though the insider selling is a question mark for some. And the price. Maybe not dirt cheap, but arguably reasonable for the quality you're getting. It ticks a lot of the value investing boxes.
So not a screaming buy necessarily, but a solid company facing some uncertainty.
That feels about right. It's this blend of enduring strengths and these very real macroeconomic question marks, which honestly makes it a fascinating company to keep watching right now.
A compelling case for ongoing observation indeed. That leads us nicely to our final thought.
Yeah, in markets that change as fast as they do now, just staying informed is absolutely critical. And if you found this deep dive helpful and want to keep building that understanding, we've got something for you.
We do. For more deep dives like this one, covering individual stocks using detailed research and analysis, make sure you subscribe to the Stock Analytics AI YouTube channel.
Absolutely. And one final important note. Please remember, everything we've discussed here is purely for informational and educational purposes.
Right. It is definitely not financial advice. Any investment decisions you make should always be based on your own thorough research, considering your personal situation and your tolerance for risk.
This analysis used publicly available data, and AI tools may have assisted in synthesizing some of the information.